Stocks are often viewed as the keystone of investing, offering the most direct method through which the public can participate in corporate success. Yet, 2/3 of millennials have indicated that they don't use stocks, citing a lack of knowledge as one of the reasons. So, what is a stock? And how does buying one earn you money? We'll answer these questions and more on today's Plain Bagel. We've all heard of stocks before, and for some, they're viewed as a gateway to wealth and prosperity. You may, for example, have heard of rapper 50 Cent earning between $60 and $100 million off of a vitamin water investment. But few truly understand how these golden tickets actually work. For one, it's incredibly rare to get those kinds of returns off of an investment. And gambling with stocks is about as successful as gambling at the casino. So let's go over what a stock actually is and how we can use it to better improve our wealth. A stock, or more specifically a common share, is a security representing a percentage ownership of a corporation's equity. Like a bond, companies sell shares to raise funds. But because you're buying part of the company, there's no outstanding amount that needs to be paid back by the corporation. How much of the company that you own depends on how many shares you have relative to how many are outstanding. If a company has 100 shares and you own 10 of them, you respectively have 1/10 of the company. Whereas small companies like independent restaurants usually have a small number of shares split amongst only a few investors, larger corporations can have their shares split amongst millions of investors. Nike, for example, currently has 1.65 billion shares outstanding, meaning that buying one share gives you a very small part of the company. So, what's the point? What's the benefit of owning part of a company, let alone such a small sliver? Well, the idea is relatively straightforward. At the end of the year, the money that a company makes after paying its expenses actually belongs to the shareholders. And there are two ways in which these shareholders get their money back: through dividends and capital appreciation. If a company makes $1 million in profit in a given year, it may decide to keep half of the money and give the remaining amount to its shareholders via a dividend payment. It's pretty easy to see how an investor earns a return with this type of payout, but what happens to the amount that the company keeps? Well, rather than pay a dividend, a company may opt to reinvest its profits into the business. For example, the company may put the money towards developing a new product that will boost sales. If the company's use of the money improves the profitability of the firm, then the value of the shares you own would increase, because now the company that you own produces larger profits than what it used to. This means that you could sell your shares to another investor for more than what you purchased them for. This is known as capital appreciation, and it represents the indirect method through which shareholders earn a return. Aside from earning shareholders money, they also provide you a vote on certain corporate activities. And if you own enough of a company, you can actually have significant influence over that firm's management. Now, also like bonds, not all stocks are the same. Companies operate within different sectors, including technology, healthcare, and consumer discretionary, meaning non-essential but desirable goods and services like handbags and video games. Depending on the sector that company operates within, the stock of that firm may act differently. For example, it's generally accepted that some sectors, such as healthcare, will perform better than other sectors, such as consumer discretionary, during market downturns. Stocks are also often categorized as being either a growth stock or a value stock. Growth stocks belong to smaller and younger companies with a large potential to grow in the future. Value stocks, on the other hand, typically belong to mature companies, and although they may not have as much opportunity moving forward, they generally produce healthy profits and can pay their shareholders a larger dividend. Stocks can further be categorized based on where they're issued. Common categories include Canadian, US, international markets, and emerging markets. International markets refer to developed countries outside US and Canada, while emerging markets refer to developing countries, which are countries that lag behind others in terms of infrastructure and economic activity. Developing countries are more prone to various risks, including political instability, corruption, and war activity. Sounds like a pretty unattractive area to invest. But as we know, higher risk tends to lead to higher return, and that holds true for this situation. This is because of something known as the catch-up effect, whereby fixed investment made in a developing country has a larger impact than the same investment made in a developed country. Think of it this way. Imagine you have two countries, one that has no access to computers and one that only has access to Windows 97 computers. We can assume that the country with access to Windows 97 is more productive than the country that relies primarily on pen and paper. Now, imagine we make an investment in both countries, whereby we provide them access to the latest Windows computers. Sure, the country with the older computers will see a boost in productivity, but the growth will be nothing compared to the country that just now is getting access to computers. We can assume it costs the same to provide the computers to both countries, yet the first country will offer a much higher return in productivity. This effect has allowed countries like India, which only became independent in 1947, to grow at a much faster rate than even the largest economies like the US markets. So now we've gone over the basics of a share, and you may have noticed that it sounds very similar to a bond. Both can make payments to the investor and have the potential to change in value, but they are very different nonetheless. Bonds are a contractual obligation, meaning that the company has to make its coupon payments if it does not want to face legal action. Dividends, on the other hand, are entirely up to the discretion of the firm, and there's no consequence for missing a dividend payment. On top of that, if a company goes bankrupt, bondholders get priority in recovering their losses over shareholders. It may seem like shareholders get the short end of the stick, but shares have a lot more potential to grow in value, whereas bonds are relatively constrained in how much their price can change. Interestingly, however, there is another type of share, called a preferred share, that acts more like a bond than a common share. Like a bond, it's relatively fixed in value, has no voting rights, and gets priority claim over common shares in the event of a bankruptcy. Preferred shares also get a regular specified payment known as preferred dividend, though there's no legal consequence to missing one of these payments. Instead, the firm has the obligation to pay all outstanding preferred dividend payments before common shares can receive any of their dividends. Wouldn't you know it, preferred shares are less common than common shares, but they're still very popular within the investment field. Great, so now we know about bonds and stocks, which act as fundamental vehicles for investing. In fact, there are many investors who only have these two types of securities. That being said, there are many other classifications that exist out there, but that's a topic for another video. For now, we're out of time. If you like this video, please hit the like button, and if you like what we're doing here, please subscribe. If you have any topics that you'd like to cover in future videos, please leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.